Hello, and welcome to another session, another lesson on personal finances. This is the third Wednesday in the month, and we do finances. I'm the budget guy, Charles Beasley, as Reginald Campbell likes to say at least. And tonight I have another interesting topic for you guys. When we were together last, I said that we were going to start discussing investments, and I'm a man of my word, and we're going to stick to that. But before we get into investment types and the different investment categories, I think we need to talk about investment basics. So let's dig in and let's talk about investment basics. With investment basics, we're going to talk about the stuff that you need to do prior to investing in any investment. And what I call it is investment criteria. So we're going to go through different investment criteria you need to do so that you can be familiar with the homework and the prep work you have to do before you start investing. Yes, I did say homework and prep work because before you put your money anywhere, you want to understand and know what you're putting it in, what it will bring, what it will return to you, and how it behaves so that there are no surprises and worst case, you don't lose your money. So as we dig in tonight, everyone needs to have investment as a part of their budget. You need to be putting your money where in places where your money's working for you. That's going to help you for retirement and later on in life, or it may help you with becoming an entrepreneur and leaving corporate America and advancing yourself in many different ways. Everyone needs investment, and they need investments more than what their job's 401k offers. You need an investment portfolio. An investment portfolio is basically a makeup of all the investments that you have. People like to diversify, which means they have money in several different places and different types of investments, doing different things for different purposes. But you need to have an investment portfolio. So let's talk about the criteria that you need to consider when you're looking at the different investment types and categories. Okay? So first criteria I will talk about is initial investment. Every investment you have, there's going to be some type of initial investment that you need to make. You need to understand the magnitude of that initial investment based on the different categories and the different types of investments that you do. Stocks and bonds will have different initial investments than real estate, than entrepreneurship, and you buying a business or a franchise or something like that, or you're buying commodities like gold, silver, diamonds, whatever. They all have some type of initial investment or minimum investment that you need to make. You need to understand what that is as you peruse through the different types of investments. Find out what that is and make sure you know. The next type of criteria that we will talk about is barriers to entry. So there are some investments where they have what they call barriers to entry. What that is certain requirements that investors need to have before they are able to be green lighted for an investment in whatever that category is. You know, some examples of barriers of investment are minimum credit scores. If you want to be a real estate investor, they expect to see a minimum credit score for the investor that's trying to invest. Minimum down payments, same thing. Real estate, they normally, if you are doing investment real estate, the minimum is 20%. Lately it's been more 25, 30%, but normally it's 20% of the investment they want you to put down up front. You also have certain types of investments that have net worth requirements. So if you wanted to buy a franchise or a business, Sometimes they ask for you to have a certain net worth to buy into the franchise to ensure that you have the funds and the capital to be able to support starting up a business, which is very expensive. And also another requirement is reserves. So real estate investing, for sure, they ask for you to have a certain amount of reserves if you're going to buy property, or you're going to buy some type of building or whatever. You have the reserves in place to cover if you or don't have, if your renters don't pay their monthly rent, or you fall short. You have the reserves there to cover, just in case there's a shortfall in any particular month. You can make your mortgage payments. So those are some examples of barriers to entry. They're different based on the different investment types. Some of them don't have any barriers to entry, but you need to be aware and research to find out if there are and what they are, and if you qualify to be able to meet the requirements of those barriers to entry. Okay, so one big thing that you want to look at, one criteria that you definitely want to look at with any investment is your return on investment. And when I say return on investment, that is normally measured by the amount of money that you gain from the investment over a year divided by the amount of investment that you put in. So let's say that you put in $10,000 to the stock market, and at the end of the year, you ended up having 17,000. So you ended up getting 7% on your money, which you got additional. You got an additional $700 based on your 10,000. So that's a 7% return on your investment. You always want to look at your investments, and you always want to make sure that you understand what the return is on the investment to know whether it's a good investment or not. And you usually measure that by how much you're able to get from a bank or any type of, I guess you want to call it, institution, what they're offering versus that. If you can beat that, normally you're doing good. Stock market, most of the time does. If you're a savvy investor, if you don't, you can potentially have less than that. But return on investment is key. In real estate and stock market, in most investments, they look at your return on investment to gauge whether it's a good investment or not a good investment. So after you determine what the return on investment is, you also want to look and do a risk assessment of that particular investment. So certain investments are riskier than others. If you invest in the stock market, it's probably going to be a riskier investment than if you invest in real estate. Because of the fact that the stock market can be volatile, go up and down, where real estate, you really don't have much volatility. If you set up your lending correctly and you have fixed payments, it's normally fixed amounts that you pay per month. You know how much you're getting in income. Whereas the stock market, as the economy and as society and as industry changes, so does the stock market, which makes it a little bit more volatile. So you want to do a risk assessment, and you want to be able to categorize your potential investment as, not risky, moderate, or risky. That way you know just what the likelihood is of you potentially being able to lose your investment versus not. Sometimes riskier investments also, you gain more, but you also have a potential to lose more as well. So now that we've talked about risk assessment, let's talk about liquidity. So liquidity is another criteria that you want to look at. Some investments require you to have a certain amount of liquidity or reserves. We talked about reserves, liquidity, kind of the same thing. Basically, what liquidity is how easy it is to convert an asset from cash and and not affect its market price. So stocks, bonds, commodities are considered somewhat liquid because you can sell those off for value relatively quickly and usually get a good value for them. So those are considered liquid, as more liquid assets than, let's just say, like real estate, because it takes effort to sell real estate, time. They're not considered as liquid as those commodities and stocks and bonds. So after you review the liquidity requirements, you also want to, most importantly, look at the historical performance. This comes into play mostly in the stock market and places like that, because you want to see the history of the particular investment that you're investing in, whether it is whether it's a company, whether it's a mutual fund, whether it is a bond, whether it's a commodity. You want to look at the historical performance of it to understand how that particular investment is behaving and potentially will behave. Obviously, it's hard to predict the future, but looking at the past can give you a good idea of how that particular investment is performing per the market and per industry. So you want to get a historical performance. You want to do the same thing in real estate. You want to look at how if it's a multifamily property or a rental property, you want to see how it's been renting, what the turnover is, how in the last couple of years it's been performing and what it's been returning to that particular investor, so that you know going in exactly what you can expect as far as performance. That's very important when you're looking at investing, because you want to understand and try to give certain expectations to the investments that you make. So going through those 6 criteria, if you stick with those 6 criteria, you'll have a good basis as far as what you can do and what you qualify for as far as investments in different categories. So I'm gonna say it once again, you gotta do your homework and your prep work. Make sure you do your homework and your prep work, and before you get out there and you understand what you're getting into. Second, please seek advice from a financial expert, a financial professional, or a seasoned investor in the particular categories you're interested in, because they can give you some insight, give you more potential pitfalls and what to watch out for. So I would say seek advice from a professional or someone seasoned proven and seasoned in the category that you're looking to invest in. And then finally, make sure that you have goals, that you set goals, and you have a plan for your investments. If you set goals and have plans, it kind of helps you narrow in on which investments you really fit with and you match to versus the ones you don't. Because if you have a plan and if you have goals, you know exactly what you want to yield from the investment, from your investments, and you can arrange them accordingly, whether it is in one investment category or multiple investment categories. We talked about an investment portfolio where you invested in different areas and different things and different categories. All of that is good, but I urge you to please do your homework, do your prep work, and make a plan. So with that, I've talked about investment basics and investment criteria tonight. We will talk about this a little bit more next month, and then we will start getting into the different types of investments so that we talk about the different categories, and we can talk about different things that you can do to diversify your portfolio and make you more successful. Thank you for your time.